emerged as influential players in the global investment landscape, managing substantial wealth while prioritizing long-term value creation. These dedicated wealth management entities serve high net worth individuals and ultra high net worth individuals, offering customized financial solutions, estate planning, and succession strategies. With the evolving economic environment, family offices are not just preserving wealth, but actively seeking strategic investment opportunities that align with their long term vision. The key discussion points for today's webinar will be evolution, purpose, and objective of family offices, legal tax governance structure of a family office, different investment strategies of family offices, challenges and opportunities in family office investment strategies, succession planning, and wealth transition. Now, I extend a very hearty welcome to all our learned speakers for today's webinar. Mr. Raman Chandana is a director in UHNI Kotak Mahindra Bank. He has more than 18 years of experience as an angel investor and wealth management. Apart from Kotak Mahindra Bank, he has worked in Edelweiss Financial Services, Sona Autocom, and Grip Invest. Our second speaker would be Mr. Himanshu Sharma. He is a Chief Investment Officer in Indus Valley. He is a seasoned professional with more than 12 years of expertise in private equity and merchant banking. He has made his first investment in the year 2012 and has worked with Aditya Birla Capital and Anand Rathi Private Wealth Management. His strategic vision and adaptness at leveraging technology to optimize investment strategies plays a crucial role in steering family office business towards becoming a leader in bespoke investment solutions. Ms. Karthika G is our third speaker. He is head of M&A and fundraising vertical in Consign's Multifamily Office, a professional consortium specializing in investment advisory, wealth management, estate planning, and strategic financial solutions. Concise MFO has been active in family office and wealth management ecosystem in South India since 2019 and manages a diverse portfolio across sectors and asset classes. Fourth speaker would be Mr. Revant Malani, who is B2B Ventures of BL Taparia Family Office. He is a core part of the investment team at the family office, where he analyzes and evaluates investment opportunities in public markets, including pre-IPO opportunities. He looks at startups at early stages like seed and pre-seed. He also monitors the performance of PMS and AIFs at FNO. Mr. Manoj Kumar, partner and head M&A and transactions of Corporate Professional, is our fifth speaker. Then we have Mr. Sanchit Vijay and Mr. Shivanshu Birla, who are the founders of Makia Capital. It is my pleasure to introduce Makia Capital. It is a Category 1 alternate investment fund led by a visionary team. Makia Capital is dedicated to empowering innovative businesses and SMEs to achieve their full potential. Makia Capital offers wide range of services, including venture capital funding, IPO advisory, and multi-family office solutions. And today we have both the founders to share their thoughts on family offices and nuances around it. Before we jump onto today's discussion, I would like to announce our next webinar would be on 7th of March 2025 on Q&A on industry standards on minimum information to be provided for approval of related party transactions. We conducted our 209th webinar last week on 21st of February on industry standard of minimum information to be provided, wherein we received an overwhelming response and more than 1,000 participants registered, and we have received more than 100 questions, but due to time constraint, we could not cater to all the questions. Thus, we have kept a separate webinar to address to all the Q&A, which would be held next week. Now, I would like to jump on to today's topic and would request Mr. Sanchit Vijay to take ahead and give us the detailed presentation on all the nuances around family offices. Welcome, Sanchit.
Thank you so much, Ruchika. So, India is witnessing a transformation in their wealth management industry. Over 1,100 ultra net worth individuals with a net worth exceeding $100 million. Billionaire households expected to rise to a 1,400 plus by 2027 as per the Rune list. Family offices have emerged as a powerful force in wealth management, shaping industries and investment landscapes worldwide. Welcome to today's webinar on unlocking the power of family offices and their role in strategic investments. I'm Sanchit Vijay from Market Capital, and it's a pleasure to have such an esteemed audience with us today, comprising industry experts, aspiring investors, and individuals curious about the landscape evolving around the wealth management and the family offices. Thanks, thanks to the unique structure and the personalized approach to the asset management within the family offices, whether you are an ultra HNI looking to safeguard your family's financial structure, an entrepreneur seeking structured wealth management solution tailored to your specific needs, or simply someone keen to understand the intricacies of how family offices operate and their strategic importance, this session aims to provide you with valuable insight that can help you demystify the complexities involved around the complete family office structure. In today's session, we will cover the fundamentals of family offices, their growing influence in the financial world, why they have become an essential part of wealth preservation, and the investment strategies for affluent families across the globe. We will be discussing several key topics within this session: what family offices are, why they are gaining popularity among today's wealth holders, how to establish a family office in India, navigating through the regulatory consideration that are paramount in this process, the tax implication and structuring necessary for long-term efficiency, which can significantly affect the overall investment performance, diverse investment strategies, how family offices play a crucial role in shaping businesses and industries, thus contributing to economic development. Lastly, we will highlight key trends that are influencing the future of family offices, equipping you with the insights to make informed financial decisions and strategic choices moving ahead. Uh, Next slide, please. So we'll first jump into what exactly is a family office. Admin, can you? Yeah. So a family office is a private wealth management firm set up by ultra high net worth families to manage and grow their assets across generations, ensuring that wealth is not only preserved but also enhanced over time. Unlike traditional investments earlier, usually people used to resort to wealth managers or private bankers. The approach has changed. Family offices take a comprehensive approach encompassing estate planning, philanthropy, tax optimization, and direct investments, thereby providing a holistic view of the wealth management. As you can see, there are some of the family offices of some big families that are there, managing their estate and enhancing their wealth over generations. Next slide. Family offices typically fall into two categories. First, single family offices, which are designed to serve a single wealthy family. These offices focus on providing fully customized solutions that align with the family's unique needs and aspirations, ensuring a highly personalized approach to wealth management. The second category is called as the multi-family offices. These offices offer shared resource and expertise to multiple families, allowing for cost efficiency and professional management while retaining a level of customization that is often not possible with traditional financial advisors. These offices serve as the backbone of structured wealth management, ensuring that the financials and legacy goals are met across generations to come. They often function as strategic partners in navigating the complex financial challenges that families face. So, to start off with, I will talk about a little bit on the history and the evolution of family offices. It's not a very new concept, but family offices have a long and rich history dating back to the 19th century, when prominent families like the Rockefellers in New York and Rothschild established dedicated entities to manage and preserve their vast wealth against the backdrop of changing economic landscape. Over the decades, the family office model has evolved significantly, adapting to modern financial markets, the global investment opportunities, and the increasing need for the structured governance in asset management. Today's family offices are more sophisticated than ever, playing a very active role in alternate investments, venture capital, and private equity. They are not just wealth managers, but strategic investors shaping industries and funding groundbreaking innovations, which have made them a very integral player in the global economy. With the increasing complexity of the global finance and the emergence of the new investment vehicles as the decade passes, family offices have transitioned from being passive wealth managers to proactive, high impact investors driving sustainable and strategic growth. They are uniquely positioned to take calculated risk that can lead to transformative changes in the industries they invest in. Some of the examples of the single family offices, as you can see: Sharp Ventures by Harsh Mariwala, Premji Invest of Azim Premji, Adani Family Office, Gautam Adani, Pavan Munjal Family Trust, um, Narottam Seksaria's family office, and like there are many others. As of today, India has 300 plus family offices currently uh, investing in various asset classes. Next slide, please. So, what exactly is the purpose of a family office? There are broad goals that defines why a family office should be made. Number one, wealth preservation and growth. Direct investments, alternate investments, real estate investments, fund selection and the asset allocation as per the customization of the family, deal sourcing and strategic partnership for the industries that the families are interested in, liquidity and the risk management, and generational wealth transfer and succession planning. Because whenever a family has generated wealth beyond a specific threshold, it is very important that the wealth is not just there, but also increases and enhances over a period of time. And that is exactly why a family office is created. Next slide. There are multiple investment avenues when we are looking at family offices. They are sort of personal investment strategies, keeping in mind the liquidity, the risk, and the return. All of these three factors in deciding where to invest: equities, fixed income, private equity, hedge fund, art, crypto, and startups are particularly some of the various diversified assets that family office typically invest into. Next. As I mentioned, that there are specifically two categories in which family offices can be divided into. These two categories are differentiated on these uh, differentiation pointers. Number one, single family office, which is fully owned and controlled by one family, whereas the multi-family office is independently operated and jointly owned, leading to cost efficiencies. The customization aspect: the single family office is highly customized, keeping in mind all the three factors of liquidity, risk, and return for the specific needs of only one family. Whereas multi-family offices offer standardized solution, but there is to the extent of customization tailored to the individual families. The cost: single family office, since it is only managing one family, there is high operating cost due to the exclusive management that they are considering. Whereas in the multi-family office, it is a little bit cost effective as the expense are shared amongst multiple families. The investment strategy in the SFO is very personalized, uh, tailored to their respective goals so that they can be aligned in that way. In the multifamily office MFO, it is a very broader investment strategies catering to multiple clients. The regulatory compliance is privately managed in a single family office, which requires an independent compliance setup. However, in a multi-family office, it is often structured with a established compliance and governance framework. The single family office is ideal for ultra high net worth families willing to set up and manage their own office. Uh, and the multi-family office is for high net worth families looking for professional management without the complexity and compliances of running a single family office. Next slide. The growing influence of the family offices in a very global landscape, as we can see, as of 2024, the number of single family offices worldwide has grown to approximately 8,000 plus, marking almost a 31% increase from 6,100 in 2019. This growth trajectory is expected to continue with more uh, billionaires, more M&A exits, more wealth being created in the startup space, with a projection of estimating over 10,000 plus family offices by 2030, representing a 75% rise from the 2019 levels. Collectively, the family offices in the global landscape manage an impressive $5.9 trillion in assets, highlighting the substantial concentration of wealth within this sector. Next slide. Within the Indian landscape, India has witnessed a remarkable surge amongst the family offices, growing from just 45 in 2010 to nearly 300 in 2024, a 567% increase over the past 14 years. The total AUM of the Indian family offices now approximately stands at $90 billion, reflecting the increased sophistication of the wealth management in the country. The demand for structured family office solution is expected to accelerate, and now we would be focusing on why the growing popularity of the family offices. Next slide. The surge in the family offices, both India and globally, can be attributed to several compelling factors. The rapid rise in the ultra HNI individual has created a pressing need for structured wealth management solution that can address these complexities of managing different and significant asset that they have created. Growing regulatory scrutiny on offshore wealth has pushed families towards compliance driven financial planning, leading them to establish family offices to ensure regulatory adherence while achieving their financial objectives and growing their wealth. Diversification across asset classes such as private equity, real estate, and venture capital has become essential for long term wealth preservation, allowing family offices to spread risk and optimize returns. And most importantly, family offices have shown a very strong preference for direct investments over traditional asset managers, allowing for greater control and better alignment with financial goals and the ability to optimize returns in a way that is often not achievable through uh, conventional channels. As a result, family offices are becoming very key players in the global financial ecosystem, driving innovation, funding emerging businesses, and supporting long term economic growth, which further solidifies their importance in today's investment landscape. Next slide. How do you actually set up a family office in India? So setting up a family office requires a structured and strategic approach encompassing several key steps that are essential for effective wealth management and compliance with regulation in India. So step one would definitely be defining very clear objectives. It is crucial for families to articulate their long-term goals, whether the focus is on wealth preservation, philanthropy, or strategic investing. The alignment ensures that the family office operates with a clear vision and purpose. The second step is choosing the right structure. Families must evaluate whether a single family office or a multi-family office best suits their needs, taking into account factors such as the level of customization that they desire and the resources that are available. The third step would be navigating through the regulatory compliances. They must adhere to the regulation set forth by the Reserve Bank of India, SEBI, the Foreign Exchange Management Act, and the income tax regulation, ensuring smooth legal operations and minimizing the risk. Fourth is building the right team. Hiring a experienced chief investment officer, investment managers, legal advisors, and tax consultants is essential for managing complex financial portfolios effectively. A skilled team can provide valuable insights and guidance tailored to the family's unique circumstances. We should also leverage technology for risk management and governance. In today's digital era, technology plays a very critical role in financial reporting, cybersecurity, and the compliance automation, enhancing the overall efficiency in setting up a family office. Each of these factors play a very significant role in ensuring the long-term sustainability and efficiency of a family office. A well-structured family office does not just manage wealth, it safeguards a family's financial legacy for future generation, ensuring that the next generation is well equipped to carry forward the family's financial vision and the name. Next step. So, tax implication of family offices. Tax planning is sort of one of the most critical aspect for running a family office, as it can significantly impact the overall financial strategy. It is really important the structure that you choose, whether it should be a trust, LLP, or a private company, which directly affects the tax liabilities and compliance requirement that the family office will face. Trusts are taxed differently depending on whether they are discretionary or specific, which influence how income is distributed among the beneficiaries. LLPs, on the other hand, benefit from being taxed at a flat rate while offering operational flexibility, making them a popular choice. Private companies have their own corporate tax rate, which may or may not be beneficial depending upon the specific investment strategy employed. So, capital gain taxation plays a very vital role in the family office investment. The long term capital gain on listed equities are taxed at 10%. Unlisted shares and private equity investment attracts 20%. Similarly, real estate investments come with their own set of taxation policies, making strategic planning essential to maximize returns while minimizing tax liabilities. Dividend and interest income further add to tax obligation, with dividends now taxed at slab rates and interest on debt investments considered fully taxable as income. For family offices investing overseas, compliance with FEMA is crucial. Regulations under the LRS and the DTAA must be adhered to in order to optimize tax efficiency and avoid legal complication that could arise from cross-border investments. Ultimately, a well-structured tax strategy not only ensures compliance, wealth preservation with all the relevant regulations, but it ensures that family offices efficiently manage their financial legacy while enhancing their overall investment potential. Next slide. There are certain common challenges and mistakes in setting up a family office. The poor communication and transparency between the family members uh, uh, leads to challenges. A little bit of casual hiring practices, too much and too fast being with investments and return. We have to always keep in mind the risk return and the liquidity quotient and factors affecting the family's wealth. Hesitancy to leverage advisor relationship, a lack of structural flexibility, not treating the family office as a business, and inadequate focus on data security and risk management. These are some of the challenges and mistakes that people usually face while setting up a family offices. But with clear objectives and agenda and properly addressing all of these factors, these challenges can be very easily overcome. Next slide. So, managing own wealth versus outsourcing it to fund managers. A fundamental decision that family offices must make is whether to manage their wealth in house or outsource it to professional fund managers. Both approaches come with distinct advantages and challenges that must be carefully considered. Whenever managing wealth in house, it provides full control over investment decision, ensuring the capital is deployed in alignment with the family's vision and risk appetite. It allows the families to maintain a direct connections to their investment and ensures that their values and objectives are reflected in the financial strategies. However, this level of control demands significant expertise and time, properly and obviously requiring a dedicated team of investment professionals, analysts, and legal advisors who are well versed in current market trends and financial planning. The costs associated with maintaining an in-house team can be substantial and may not always yield the desired returns. Whereas outsourcing wealth management to experienced fund manager provide access to seasoned professionals with deep market knowledge and specialized expertise. These fund managers bring investment discipline, access to exclusive opportunities, and risk mitigation strategies that can enhance overall portfolio performance. However, outsourcing means relinquishing a degree of control and paying management fees that can eat into the returns and potentially resulting in a misalignment between the family's goal and the fund manager's strategies. By carefully balancing in-house management with outsourced expertise, there can be a hybrid approach as well. Family offices can optimize their investment strategies while ensuring their alignment with their long-term goals. Next slide. There, since we did in-house versus outsourcing, I think it is imperative that we do a family office versus AIF and PMS. The key differences that are there. Family office is often compared with other structured investment vehicles such as AIF, NBFCs, PMS. Each of these options has distinct characteristics, regulatory requirement, have their own distinct advantages, and different implications on wealth management. AIFs pool fund from multiple investors to invest in alternative assets such as private equity, hedge funds, or venture capital. While AIFs are regulated by SEBI, they offer flexibility to individual families compared to a family office, which can tailor investments to meet specific family objectives. NBFC primarily operates in the lending and the credit business, providing an avenue for structured finance. However, they are subject to regulations, RBI regulations, making them a more restrictive option for families looking for investment flexibilities. PMS service provides discretionary or non-discretionary portfolio management for HNIs. While they offer professional expertise and investment management, they do not provide the same level of customization and direct investment control that a family office does. The key advantage here of a family office is to ability to tailor investment decisions without the regulatory constraints imposed on any other investment vehicle. This flexibility, combined with a holistic understanding of the family's wealth and aspiration, makes the family office an attractive option for ultra high net worthy families seeking long-term wealth preservation and the ability to adapt to changing market conditions. Next slide. Certain trending sectors that family offices uh, invest into. So emerging sectors in AI, fintech, healthcare, green energy. And within the geographies, India definitely is a very big uh, geography where family offices invest. Southeast Asia, Middle East, and Africa are there. Direct investments, which is a preference for direct startups, takes over the LP's role in the fund. Sustainable investing, digital assets, and the co-investments with the PE firms, VCs, and AIFs have are very trendy within the family offices landscape. Next slide. So the role in strategic investment when it comes to a family office is they have a long-term investment approach. Obviously, family office focus on value creation over multiple generation, um, prioritizing sustainable and strategic investment rather than short-term gains. Uh, Unlike the VCs, which operate on fixed fund cycle, family offices provide a lot of patient capital, allowing businesses the flexibility to scale at a natural pace, which makes them very ideal uh, investors for capital intensive and art research and driven uh, development driven sectors such as deep tech, clean tech, semiconductors, where the product development and commercialization takes time. Family offices are evolving beyond traditional wealth management and are now placing a very increasingly active role in strategic investments across multiple sectors. Next slide. So a hands-on deal structuring and exit planning is also a role that family offices go beyond passive investing, because they take a very active role in structuring deal. They carefully plan their exit strategies, considering their long-term value realization. And strategic exits would may include like IPO, secondary sales, or intergenerational transfers, ensuring preservation of wealth. Next slide. Risk mitigation through diversification and global exposure. So it is a very highly diversified portfolio across public and private market, alternative assets, real estate and infrastructure, geographic diversification. This multi-asset, multi-geography approach protects against downturns and ensures steady wealth growth for the families. Next slide. Beyond capital, family offices bring a very deep industry knowledge, strategic marketing insights, and a very powerful network to their portfolio companies. Their strong understanding of the Indian market, the consumer behavior, and the regulatory landscape help their investment portfolio companies navigate challenges and seize opportunities in a way they couldn't have imagined. So, mentorship and advisory, industry connections, operational guidance are some of the very big advantages that family offices give beyond just the capital. Next slide. So, let's talk about the types of strategic investments that the family offices do into. So, first and the foremost, let's start with private equity and venture capital. Family offices are bypassing traditional investments funds and directly invest in high growth startups, private companies. This allows them to leverage long term capital for strategic value creation while fostering innovation. I think, for instance, we can always talk about the Catamaran Ventures and Premji Invest, which have successfully built strong investment portfolios in technology and consumer businesses, harnessing the potential of emerging markets. Uh, Next slide, please. Yeah, next slide. Next, strategic, the previous one. Yeah, strategic mergers and acquisition. Many family offices act as strategic investors, acquiring stakes in companies that align with the business interest and values. This particularly is useful for succession planning in family-owned businesses, allowing for strategic growth and controlled legacy transitions. I think notable example could be from the Reliance family office acquiring various startups and companies to strengthen the geo ecosystem, ensuring continued growth and competitive advantage within the landscape. Next slide. The third strategic investment would be around the real estate and infrastructure. Real estate remains a very core asset class for family offices, providing stable cash flows and long-term value appreciation. Investments include commercial and residential properties, logistics and warehousing, renewable energy projects, which are focused on very ESG focused investments, reflecting a very commitment to sustainable development. Tata's family office focus on a lot of real estate and infrastructure projects. Next slide. So a very new and interesting investment strategy of ESG and impact is in investing have been coming up a lot within the family office landscape, aligning the investments with their philanthropic goals, focusing on very sustainable businesses, clean energy, and social impact projects that yield both returns and positive change. Uh, I think the Rockefeller family office has pivoted towards sustainable investment to create long term positive change, demonstrating how wealth can be a tool for good as well. Next slide. Alternate investments to hedge against risk and ensure returns. Family offices are diversifying into hedge funds, cryptocurrencies, and commodities. Even the Amani family office has ventured into the blockchain and AI driven startup as a part of their long term investment strategies, showcasing their adaptability uh, to technological advancements as well. Next slide. Supporting innovation and entrepreneurship has been a very core deep rooted thing within the family office. By investing in R&D, deep tech startups, and industry aligned businesses, these family offices are driving industrial and technological advancements, playing a pivotal role in shaping the future's economy. The Walton family offices, Walmart, has been investing in retail tech startups to enhance Walmart's supply chain efficiency, illustrating how uh, strategic investments can lead to operational improvements. Next slide, please. Previous one. So, I think with respect to how professionals' wealth structuring enhances return, as I mentioned, there are three things that anybody has to focus on is the liquidity factor, the risk, and the return. Access to exclusive global investment opportunities, ultra high net worth families benefit from private market investing in pre-IPO anchor investment, doing co-investment deals, or direct real estate and infrastructure investments lead to an exclusive return for the family offices and generating and enhancing the wealth of the office. The second is the risk adjusted investment for optimal wealth growth. Uh, there are different techniques that professional wealth manager use in a data driven approach, ensuring that the risk is minimized, um, keeping in mind the factor that it is aligned with the family office's goal. Uh, Asset allocation diversification is a very important factor, which takes into account the liquidity factor as well. So investing into the private market, real estate, alternate investments, public market, these are well-structured portfolios spread across and diversified to manage the risk and liquidity. Next slide. What makes family offices different from wealth managers? Next slide. I think in the end, it's how family offices support businesses beyond capital is, as I mentioned earlier, strategic partnership is primarily connecting businesses with industry leaders and investors, the mentorship and advisory, governance and compliance, the operational excellence and expertise that they have, and the social impact support that they provide is something that businesses require just beyond capital. Next slide. Uh, I think we'd be concluding it in a way with the takeaways would be family offices are playing a very increasingly influential role in the global and the Indian wealth management system, and their impact is only set to grow in the coming years. The shift towards structured investment strategies has led to a very rapid rise in family offices, especially in India, where a number of wealthy individuals seek tailored solution for their financial needs. And with this family office setup in mind, it provides a very greater control, customization, flexibility compared to the other investment vehicle, positioning themselves as a strategic partners in their wealth management. The ability to strategically invest across multiple asset class makes them a key driver of financial economic growth. Choosing the right structure, leveraging expert knowledge, and adopting a technology driven approach is crucial for long term success. As we move forward in the evolving financial landscape, um, how how family offices can help achieve the financial aspiration is a major lookout. Thank you so much for your time and attention. And um, I look forward to your questions and discussions on how family offices can drive strategic investments and contribute to building a sustainable financial future going forward.
Thank you, Sanchit. Thank you for such a great and extensive presentation. It was quite insightful. Now, I would like to invite Mr. Revant Malani. Just to again introduce him, he is from BL Taparia Family Office. He is a core part of investment team at the family office, where he analyzes and evaluates investment opportunities in public market, including pre-IPO opportunities. He looks at startups at early stage, pre-seed and seed. He also monitors the performance of PMS and AIFs. Welcome, Mr. Raven. You may please provide us your views on the topic. Thank you.
Sure. Thank you, Ruchika. Thank you, Sanchit, and thank you, Shivanshu, for this opportunity. I'll get started. So, India's private consumption has nearly doubled from 1 trillion in 2013 to 2 trillion in 2023, growing at a CAGR of 7%, outpacing all the major economies in the world. For example, USA, China, and Germany. It took a decade to double this consumption spend, but from now till the next trillion, it will be much quicker. Let's say for 8 years from now, and then for the next trillion, 6 years, and improve from there on. This surge in consumption is primarily fueled by the expanding middle class population and rising disposable incomes. There are a few factors that influence the spending patterns of consumers. Firstly, budget. This year's budgets focus on pro consumption measures, including income tax relief and raising the thresholds for TDS and TCS, thereby putting more money in the hands of middle class customers. The consumer landscape in India is undergoing a major transformation, particularly driven from Gen Z and millennials, who account for more than 50% of India's population. These younger consumers are prioritizing quality, convenience, and experiences over the price. This trend towards premiumization is opening up new avenues for FMCG companies. The e-commerce market in India is currently uh, valued at 150 billion USD and expects to grow at a CAGR of 19 to 20% until the end of this decade. The quick commerce market in India has recently started and it's already at 3.5 billion and is expected to grow at an even higher CAGR of 35%, with bigger players such as Amazon and Flipkart entering this space. The use of digital currency like UPI or credit card catalyzes the growth in spending. I'll give you an example. So, if you go to a mall to buy a pair of shoes, you will either you pay in cash or you pay in credit card, right? So, if you pay in cash, it kind of pinches you spending 10 notes of 500 rupees, than you tapping the card and being like, I'll pay this next month, right? So, this is also catalyzing the spending. Now, India is also going through an economic transition. So currently, the per capita GDP of India is about 2,700 USD. And historically, as the GDP per capita reaches $3,000, countries typically experience a shift in their economic structure and consumption patterns. There are more people who start spending beyond the necessities and start consuming higher quality and branded products. And further, other sectors will also benefit from this growth, such as automobile, real estate, retail, durable goods, tourism, and etc. So this has been seen in an example of several countries, like China, for example, in 2003, when they reached their $3,000 per capita GDP, it unleashed a significant consumption boom. Even, for example, South Korea and Taiwan, when both of them started with their per capita incomes around 10 to 20% of US levels, approximately at $3,000, and rapidly progressed to 60 to 70% of US levels. So, as a family office, more than 60% of our investments are mainly in the consumer sector since we believe in the story. We enjoy this theme since the sector is mostly dominated by big players like HUL, Nestle, ITC, Dabur, Marico, and etc. And they're making a lot of acquisitions of startups to integrate them into their brand nowadays. This is mainly due to the personalized touch of the smaller firms to give their customers, which the big MNC companies are not able to. So some examples are HUL taking over Minimalist, or Marico acquiring Beardo, or ITC taking a majority stake in Yoga Bar. Thereby, quite a few family offices nowadays are shifting their focus onto consumer startups. In conclusion, India's consumption story for the next 5 years is intact for remarkable growth. By 2030, India's GDP is projected to cross 7 trillion, with consumption making more than 60% of the economy. That's all for me. Thank you so much.
Thank you, Mr. Lani.
Thank you so much, Revan, for joining the webinar and sharing your thoughts on how you see things through a lens of a family office. So, maybe I know that you'll have to maybe hurry up somewhere else, but just a couple of questions to, maybe deep dive into your thought process. So, how, just to wanted to know if you're thinking about the consumer segment per se, right? So, actually, what is the role of promoter when you are actually investing a fund in, for example, X and Y company? So
Yeah.
how are promoters also, seeing those investments? Is it like you are the final decision maker for those investments, or is it like you also have to, take everyone on board? So how does it happen in a typical family office environment for you?
So how it happens here, it's a startup, right? When we're investing in a startup, they don't have much experience, they don't have a good network, right? So when we come as a family office, we're not only putting our money into it, we're putting our efforts into it, like raising it as our baby, right? From scratch, giving them the network, giving them the experience from what our companies have gone through, right? We come from a experience of manufacturing background, so any startup related to manufacturing, we're easily able to help them out solving like the baby issues that they face in the first few years.
Amazing, amazing. And last questions, and because I just wanted to make it more interesting for everyone to hear as well. So can you talk about any particular investment that stood out for you, so that just for us to for as a reference point?
Yeah, definitely. So, if you guys would have heard about Frido, they have their pillows really got famous, right? So now they have a bunch of products that are available. They're every other month they're removing new products. So we got in at an early stage when the revenues were around 10 lakh per month, and now I think they're doing around 18 to 19 crores. So that has been a
Oh, wow.
significant growth story.
Oh, that's amazing. Mhm.
Yes.
Anyone else, if anyone else would want also, so I would want make it as a panel, and obviously as an audience also, we can make it very interactive. If anyone wants to pose a question or just be more curious about it, so would be great. But yeah, thanks so much, Raven, for joining and again answering the questions.
Thank you so much.
Thank you, Raven. Thank you. Okay, so now I would like to invite Mr. Manoj Kumar, who is partner and head in corporate professional in investment banking and M&A division. Welcome, Manoj sir, to speak on the topic and share your thoughts.
Yeah. Thank you, Ruchika, and thank you to all the panelists. I think Revan has given a very good insight about the investment strategy of Taparia Group. I believe he is managing the fund, and how these family offices are taking the companies, taking the startups to their next level by investing in this. So obviously, Sanchit has given a detailed discussion on family offices, how they are structured, how they are doing wealth management, and being the not only the custodian of family wealth, but they are evolving as a dynamic investment powerhouse and growing. I would just like to put some focus towards the multi-family offices, as Sanjit has already discussed, but their importance is increasing day by day, considering various factors. So traditionally, in India, the wealth was created through the family-driven businesses. Most of the companies which are now listed are promoter-driven companies, and they, whatever the wealth is created, they generally parked in real estate or bullions, etc. Then slowly they pass down the investment to the next generations, and sometimes the next generation would create new business line or maybe expand the existing business line and continue. But then the era came where the cash surpluses were invested through private banks and fund managers, etc. So that was going on, but slowly the dynamics are changing. There are now thousands of people who are becoming ultra HNI or HNIs through their startups or otherwise exiting from their investments, and they need more structured investment opportunities, diversify their investment to various things. So they need personalized approach, and they want to invest in startups, in private equity, new age business like fintech, renewable energy, deep tech, etc., etc. Then many of the family offices or HNIs have vision of investing in impact investment like green energy or maybe some philanthropic thing, edutech, etc. So those kind of opportunities are also creating a lot of buzz these days. So like we have seen uh, Gopal Krishnan's family office has invested in many fintech startups, renewable energy startups, deep tech. Similarly, by Jirodha's Nitin Kamath is continuously investing. So some other family offices like Ajim Premji's office or another family office are doing more of impact investment. Then there are other family offices who have co-investing in a startup, directly investing in companies and promoting entrepreneurship, like uh, Taparia Group, as just Revant has told. Then many of the people want to invest in many other international market. They want to invest in listed companies abroad or real estate abroad. So all those things create a lot of hurdles, a lot of problems also, like governance issues, structuring issues, tax planning issues, regulatory hurdles and regulatory planning issues, then risk mitigation and minimization. All these things uh, creating a lot of new kind of problems. And for that, the multi-family office is one of the good solution. We have seen that earlier the investment were made in through PMS, let's say. So PMS are only investing in capital market through securities listed on various. They are regulated by SEBI, and they are only providing that kind of solution which is available to limited aspect. However, uh, if the intent is to invest in various class of assets, then they are not good structure. So but the family offices want to invest in PMS, maybe they are also, the multi-family offices are very well structured organizations. They have various specialities, expertise. They have maybe some chartered accountant, company secretaries, lawyers. Sometimes they have good investment bankers, and all those people are advising in multiple things. They help in succession planning. They also help in creation of will and success. Sometimes they advise on taxation aspects, international taxation aspects. Even they work on lifestyle of the people or family members, or maybe in international travel, etc. So all those kind of advisory services are not possible from any other structure. And if a family is trying to create such kind of structure in-house, it will be very costly affair, because there will be huge manpower involved, and that can be done only by ultra HNI families, not by normal HNIs or who have a small wealth of, let's say, 50 crores or 100 crores. That may not be a feasible option. So here comes the option of multi-family offices. So this concept of multi-family offices gaining importance day by day. And many of the multi-family offices are getting created. They are advising to multiple families. They are providing customized solutions, and through technology and AI data analytics, they are making investment decision smarter, investing in more efficient way, and providing good return also with a very cost efficient manner. So that makes the family office and multi-family office very important aspect. One more thing, family office or multi-family office gives greater control in the investee company, because they are directly investing in the company as per the instructions or directions or thesis of the family, and they help in growth of the business. They take part in the decision making, operational decision making of the investee companies. Then the return of investment is also higher, because they bypass the fund managers, intermediaries, etc., and they also always align to the long-term vision of the family. One very important aspect why I am advocating multi-family office is, we have seen just 2 days back, there was an article by Mr. Harsh Goenka in ET, and he has given very alarming situation of young entrepreneurs, or the next generations of entrepreneur. He quoted the statement of Uday Kotak, legendary banker, that India's young billionaires are spending more time in playing on the stock market than building actual companies. Instead of rolling up their sleeves and sweating it out in the trenches of business and industries, they are busy in trading and speculating business. So this is very alarming situations. The successors of the family businesses should focus on, they have very good platform. They should focus on creating new businesses, and they should have entrepreneurship rather than just managing their fund. So they should let the professionals manage their fund and give return for their, and preserve their wealth, and they should focus on the business creation. New entrepreneurship is very important for the growth of the company. If we want to take India to be a Viksit Bharat, certainly the entrepreneur should come, and that can come only if the next generations of the big families involved in the creation of new business lines, new kind of business opportunities. Then there will be a lot of employment generation, demand creation, and obviously export-driven business can also grow. So focus should be changed. That is my view, and I think other panel members can also add to that, because that is very important, that people let the expert do their work and focus on what is for them already in the platter. That should be the focus, and that's why I am saying, advocating towards the multi-family office, which is a professional organization. And I think we can discuss further if there is any thought.
Thank you, Manoj sir. You very rightly mentioned that the role of multi-family offices or the family offices or the professionals is very important for wisely managing the investment. And I think to discuss further on this aspect, I would like to invite Mr. Shivanshu Billa, who is one of the founding member of Makia Capital, who is actively working towards, advising the family offices how to set up, how to take things ahead. So over to you, Shivanshu.
Thank you so much for the introduction again, Ruchika. I think I bumped into Revan's conversation because it was very intriguing. But yeah, just to circle back on what we have discussed, I think Sanchit gave us an overview on how the multi-family office and family offices in general are functioning and adding value to the overall economy of India. And rightly pointed out by Manoj sir that because now I just saw a tweet from Nikhil Kamath where he says that now the volumes in the market have dropped 30%. So now I think, Manoj sir, the people, or even the younger population of India is more focused toward other things rather than the stock market, because now the market has fallen up considerably. So yeah, now on the multi-family office aspect of things. So as Ruchika introduced me, I'm one of the founding partners at Makia Capital. So Makia Capital is basically a VC fund, and we invest in certain opportunities when it comes to pre-IPO, anchor, and preferential deals as well. So we deal with a lot of family offices as well. But I think on the panel we have much more experience and nuanced people. So I'll be conversing with Himanshu. Himanshu is also a founding partner at Strategic Alpha and also looks after the family office of Indus Valley. Raman, I think I can speak a lot about Raman. So he technically was my obviously ex-boss and now a very good friend. And he was earlier on managing family office of Sona Comstar. It's a listed company. Then we went on to manage a fund together at Grip Invest. So he was the CIO, and I was, assisting in every way I can. So we were doing the fundraise, we were deploying it across different asset classes. And obviously, we also have Karthika. She's from Conscience Family Office. And just to give her a background, she has been dealing with many family office, helping in their, investment journey, planning their every horizon for when it comes to succession, taxation, and everything else. So we'll be talking about it. And in next 1 hour, maybe we can keep, or maybe next 30, 40 minutes, we'll be doing it, I think, in a very interactive way, if it's possible. Obviously, we can pinpoint certain things to ask anyone, but we can also discuss and cross question so that, we are able to get more out of the time that we have. So, so again, maybe we can begin with Raman. So Raman would love to, understand your point of view, because you were also initially with Edelweiss managing, such UHNI money, and then went on to go to, Sona Comstar as a CIO, then fund manager, and again now handling money for the UHNI. So you are the big money guy that I see, and obviously a mentor. So would love to understand your view on how this space is evolving and how do you see the markets and everything else. Up to you, Raman.
Good. Thank you. Thanks, Shimanshu. Thank you, everyone, and pleasure to be here. I have been now part of financial service for 18 years. Started servicing or working with family offices back in 2013, when the family office as a concept was not even there in the country. Today, we hear about family offices left, right, and center, and they're very actively investing in the market. But at the time when we started back in 2013 at Edelweiss, there were a couple of family offices, but those were more philanthropic arms of large corporates like Premji or Narayan Murthy, who were practically investing for a purpose of putting money into philanthropy. Over a period of last 10 to 12 years, a lot of wealth has been created, and you guys are at the forefront of creating that wealth by doing a lot of IPOs and pre-IPOs, all of that is happening. Plus, the secondary market that has become, whether it's private equity stake sales or mergers and acquisitions that have been happening. What this has led to is the fact that a lot of new money has come into the market, and that money is fairly high risk money. They want to invest in equities, they want to do startup investments, because the only way that they've understood or made money is through investing in businesses. Um, so this entire trend of family offices has picked up and is picking up pace on a daily basis. What we also, so right now, what we are seeing, and a move towards more autonomy and more advisory based family offices, where they are not actually very stuck up with either one type of investments, one type of product suite, whether it's AIF, PMS, etc. They want the wealth management team or the multifamily offices to be on their side of the table, rather than selling products to them, actually doing asset allocation for them on a better basis. So a lot of large or medium sized family offices are actually now working towards having a more open architecture with the wealth management firms. Also, they want lesser products. uh, Today also, if you look at any large family office, 60% of their investments will still be in mutual funds, whether it's debt or equity. 60% of that money will still be mutual funds. It'll be through ETFs, it'll be through known funds. So a lot of wealth still goes and resides into mutual funds as well. The rest 30-40%, which is left, goes into alternate investments, unlisted markets, all of the others. So primarily, this market is still, and this is a trend that will continue. In bad times, in bear markets, actually the trend will reverse, where people will stop investing in AIs, PMSs, etc., and will stick to basic mutual fund investing in and ETFs. So this trend already we've seen over the last 2-3 months of market fall. We've seen people actually reducing their allocation towards new AIFs, new products, and PMSs, and move back towards simple investing. Larger family offices over the last 1.5 years have actually moved to very simple based investing. They don't want to do difficult products that are very difficult to understand. Private credit market, while the numbers are big, it's more institutions rather than family offices that are participating in them. So private credit market in that sense is getting a different set of money rather than family office money. So that's broadly from my end. Happy to answer any questions if you guys have.
Raman sir, very
Sure.
fantastically said all these
Sure,
things.
Raman.
A simple question from you. Like, because I worked with Anand Rathi Treasury and Aditya Birla Capital. So right now, what I see, like in family office, earlier people used to go in debt side and buying debt mutual funds, right? And nowadays, what happening? I don't know what is happening. They are going for a single paper and they are having a conviction on the company and they are saying we want to buy this particular company as a company. That's not an equity investment, but
Right.
they are investing as a debt investment. But the concentration of that investment is like equity. So I want you to just keep some light on this. Why this, like, because you have a vast experience in this. So if in family offices or the UHNIs are putting large amount of this investment in debt side, so will it is feasible to them or it is risky?
So it depends, right? Bonds, corporate bond market is actually, and Shivanshu and I built the entire corporate bonds piece at Grip Invest. I believe that corporate bond market is very misunderstood in India. Uh, you do a basket of bonds, put it through a mutual fund, you make 7.5%. If you can do in-house research and do the same basket of bonds, you will make anywhere between 8.5 to 9%. Okay, so that 200 basis points or 150 to 200 basis points difference is a very large difference when it comes to debt allocation. So a lot of smart asset allocators and family office guys are actually thinking that, what is there, a AAA allocation may, I am giving you 50 basis point or 30 basis points of fee. It doesn't make sense. I can just buy it myself, right? An HDFC bank, which is available at 7.5, 8% to a mutual fund, is similarly available to you as well. And you don't need to do a research on HDFC bank whether the bond will fail or not, right? You create a 70% portfolio of AAA odd, and then for alpha you buy a AA plus or a AA or A plus paper for generating that alpha on your debt portfolio to go around 8.5, 9%. That's typically what family offices, etc., and a lot of treasuries have started to do now. Rather than, while it's easier to just do one mutual fund if you're not into the business of making money through your treasury, then it's easier to do mutual funds. But if you're substituting 6%, 7% return to 8.5%, it's great to do that. Also, we have to remember that we are still in the high interest rate scenario in India, right? Interest rates are practically all-time high. So this is a good time to actually build a bond duration portfolio, assuming the fact that in the next 2 to 3 years, the interest rates will come down. Shivanshu and I used to keep talking about this very simple trade that nobody used to talk about. Just buy the 30, 40-year GSEC, right? Very simple trade. Nobody talks about. No wealth manager will go and talk to you about and give you a trade like this. Primarily because wealth managers don't make money off this. So
Absolutely.
30-year GSEC you just buy, you make 7.5% on the bond. If in 3 years interest rates also come down by 1%, you make around about 18% odd return on that. So 7.5 for 3 years for 21% and another 18% on your duration. You're talking about nearly 40% return in 3 years in a debt investment. That is as safe as India is. I don't know whether in 3 years equity markets will give you 40%. First, they'll go down by 40% and then give you 80% up. I don't know, right? So a lot of times, people are now realizing also the cycle of interest rates being high has been very, very long, both in India and in US. So it is very clear to everyone that interest rates will come down. So today, now the call is when will it come down, not whether it will come down. So that is also leading a lot of family offices to take a call on duration today. And directly buying bonds or GSECs is a better way of doing it, and you make more money than waiting, then putting it through the funds, etc. I hope I answered that question.
Yes. Yeah. Thank you.
And Raman, how do you think so? Because you have seen both the sides. You have managed funds, and you have also been you have also been a CIO. So as a promoter, if I have to hire someone to manage my investments. So how do they think about hiring the right CIO and the right team? And then how, as a fund manager, you are able to identify the right fund managers for your AIFs or right bets for your direct investments. So just a brief, if you can, your view on that.
Yeah. So very interesting. Every family office is very unique, right? And I'm pretty sure that Kartika and Himanshu, you guys work and talk to a lot of people. Every family office has its unique set of problems and unique set of requirements. In the family office that I was working in, the promoter himself didn't know much about investments because he was a businessman, right? He only spent all his time in business. So he wanted a guy who was very well attuned to what the markets are doing, what's happening. So he wanted that guy. There are a lot of family offices, and majority of family office guys that you will meet primarily at the very senior level, the CIO levels, will be more operational guys who were more finance guys, accountants, CAs, uh, primarily one because they've been in the organization for a long period of time. So they were accounts manager, finance manager, and then they grew in stature in the company. Or, if somebody from outside, because the family office role is not just investing, but also to manage a lot of these companies or trust structures, doing estate planning. All of that has to be involved. So you have to know all that aspect also, plus investments. It's very difficult to find that one person. I was more from an investment standpoint that my founder wanted that. So that's why I was selected as CIO. And then, obviously we worked together in understanding estate planning, trust formation, all of that. We made mistakes, we learned, but eventually we came up to a structure, but we hired the right set of people around us, right? As far as team building goes, team building, depending on the size of the family office, becomes important. If it's a family office that does a lot of equity investments and has a lot of money, then they primarily start building an equity or an unlisted equity team. Debt is still managed through advisors like us at Kotak, right? So they'll give us the debt portfolio, equity portfolio, they'll manage themselves. Depending on what the need of the family office is, it depends on that. But overall, lately, I've seen a lot of people from private equity funds or VC funds, from a senior analyst or a partner level, moving to family offices because the bent of mind have become a little unlisted in their mind, that the majority or the big money is being made on unlisted side. So a lot of people have started making unlisted teams also in-house.
Thank you so much for answering that, Raman. And just moving on, Himanshu would love to know about your experience. You have been a CIO at Indus Valley, and last we met at Mumbai, and we obviously met a lot of other family offices as well. So you have been the forefront for them for equity investments and everything else. So would love to know about your experience and how has the journey been. So yeah, up to you, Himanshu.
Thank you, Shivans. Thank you, Sanchit. Thank you, corporate professional team. So I'll not take you to the deeper side, but let me tell you how family office things comes into in my picture and how it started. So I started my journey with Aditya Birla Capital. I was financial analyst over there. Then I joined Anand Rathi. I was managing their treasury around 8,000 crore. Then I incorporated my own company and managing multifamilies. So the basic understanding of mine, as Raman sir rightly said, every family is having their own psyche. And trust me, if there are 4 members in a family, then you have to make a strategy on the basis of all those 4 objectives, all those 4 people objectives. It's not like because there are 2 points. As Manoj sir said, there are 2 types of family offices nowadays in pictures: single family office and multi-family offices. Earlier, there was not multi-family offices was there because in India, people are having that kind of, you can say, anxiety that they don't want to share things with other. But now things are opening up and emerging. Now people are taking bets, like they are saying, we are buying business. Now this, from last 2 or 3 years, or maybe in 5 years, what I have seen, like now promoters are saying, we are buying businesses. This is the business of buying, right? Earlier, what we used to say, we are investing in equity. We are buying this stock. We are buying that stock. But what they are saying right now, we are buying businesses. We bought this much of stake. What does that indicate? It indicates 2 factors. First factor, they know how much risk they are taking. So if you will deal, like I deal with Kothari Group and all the big family offices, what I understand from them, they say 18% to main bana lega. It's not a big deal because we are doing in our business. What more you can do, right? So then other family member is saying, I want to just preserve my wealth. Second, Third objective, somebody said, if anything happened to them, that transmission should be good. Fourth is saying, I want to take, high risk. My risk should be like 2%. I want 20% return, something like that. As a CIO, as a fund manager, you have to see all these things and then make strategy. So what I used to say, on the basis of family, we build strategy. And then we implement that strategy and we monitor that strategy. When you are working as a CIO or a fund management, the major responsibility is monitoring the whole portfolio. Because monitoring a portfolio is also a different art. Managing is different. And for example, if you are buying any mutual fund, so every family member is having their own psyche. Why not this sector? Why not that sector? Why not that sector? As a CIO, you should have a proper methodology, selection methodology of fund manager, selection methodology of mutual funds, selection methodology of debt funds, selection methodology of the pre-IPO or other AIFs and PMS. Because when you are saying something is good or bad, you should have numbers in your hand, right? So how I manage, what are the things I do? I'm just explaining all those things. I always used to say qualitative statements can be changed, but quantitative can't. So we have to rely on math. Math cannot lie. So we say, or I always used to say, sir, let's bring mathematical construction model into the portfolio. What is mathematical construction? Everybody is saying something like that. So what it is, if the portfolio is going down, for example, if Nifty is down from top to now is 15.78 or 16%. So promoters are not worried, because in an initial stage, when you were making this strategy, you were telling them, sir, if market go 10% up, this is called stress test analysis. If market go 10% up, our portfolio or our fund will be like this. If market go 20% down, we will be like this. If market go 20% up, we will be like this. And it is not related to only equity. So I will share one of the good example of our investment, what we did. When people were busy in chasing or finding good stocks or investment opportunities, what we saw, there is a fund called Gold Mining Fund. World Gold Fund is the fund name. So what that fund do, we saw that from last 12 years, gold mining companies haven't seen a new order book. From 12 years, they are stagnant. People are chasing stocks, people are chasing all these things. What we show, जो खाली पड़ा है उसको देखते हैं. And what we got to know that, okay, US is in trouble, or down the line, when country needs to come on some stage, they needs to keep gold as a reserve. So we took bet on gold mining fund. What is gold mining fund? Like the companies who are digging gold. In our country, there is only one company called Deccan Gold, and we are not relying on that company because of some financials and all those things. We are stayed away from that. So we bought a World Gold Fund. In last 6 months, if you can see the returns, and this is just beginning, 46% that fund grows. So what makes me like that? So it's like collecting all the dots together and forming a line, and then saying all these things to promoters. Sir, we should wait for 3 years. Maybe I'm saying 12 years, this bet can also take 2 more years. But this is the thesis. So on the basis of thesis and things, these things comes out in the pictures. And yes, monitoring, because risk can be managed in number. If we are saying risk is high, low, medium, it can't work in family offices. You have to say precisely, sir, this much risk we are taking on our portfolio. And this is the probability that we will get this much of return. So this is the mathematical construction model which we bring into the picture. Monitoring plays vital role. So we all needs to monitor our portfolio precisely. As Sir said, Sanchit said, and Shivanshu also said, and Raman Sir said, because market, whether that is market, bond, anything, it's all are cyclical. So when cycle will turn around, how you will get to know? So monitoring plays vital role. So this is a little bit, I keep some light on that. And if anybody is having any doubt, feel free to ask me.
Thank you, Himanshu. Just to ask a little questions around what you said. You mentioned monitoring is important. So what are the key pointers that anyone needs to, put focus before, taking that decision to invest or when to exit? Or so like just some key points which you think can be
Perfect.
explained.
So I can say, I think Raman sir will also agree on this point, or all the panelists. When we are monitoring our portfolio, what we show, जो अच्छा grow हो रहा है. As an investor, I'm talking about. Oh, this is growing. But when you are seeing on the family office point of view, we have to see the entire portfolio. Entire portfolio means what? All 5 asset class. So 4 asset class are already there in the picture: real estate, gold, equity, debt products, and fifth is crypto, which is some people are taking it, some are not taking it. It's like that. So what I understand, when you are seeing any portfolio, see on each and every asset class wise. When you are seeing only equity, then compare with that benchmark. When you are seeing real estate, just see, because asset allocation plays vital role into the picture. If you are having heavy on equity from last 6 months, your portfolio will be down by more than the market. If your asset allocation is right, so asset allocation is the first thing, then sector allocation is the second part. First asset, then sector, then talk about this equity and bonds. So allocation plays vital role while monitoring any portfolio.
Yeah, correct. And I think even the monitoring aspect would differ depending on the asset class, right? So, for example, for debt, it's more about the macro side of things, and
Absolutely.
equity could be micro as well. So yeah, moving on, we also have Karthika with us, and would love to, Karthika, would love to hand over the mic to you, and would love to understand about your point of view when it comes to family office side of things. So I think all of us have a very strong presence when it comes to North India side of things, and you have a very strong presence in Southern India. So is there a different psyche that the people follow in South India? And how do you think about investments? So would love to hear about your views on this.
Thank you so much, Shivanshu, and corporate professionals for inviting us. Shivanshu, we really enjoy your content on LinkedIn. We read it almost every day.
Thank you so much.
Yeah, I'll quickly introduce the firm. We're Conscience Multifamily Office, started in 2019. And to answer your question on whether it's different in South India and different in North India, no, we're all the same. But I think one key aspect of financial management, any kind of financial professionals, I think, is integrity and that personal trust. So it's purely the advantage of our location. So we are connected to the families in this ecosystem, and so sort of it helps us with our presence in this area. And of course, there are a lot of players in North India and Mumbai, and so we sort of have that early advantage of being here in South India. And as like how both Raman and Himanshu have highlighted, each family has their own needs, have their own priorities. So it's the approach to things are different for each family. In our experience, especially in recent times, we've been seeing a lot of interest in private credit space, and of course some really good alpha in both the unlisted pre-IPO markets as well. And like how Mr. Himanshu and Raman mentioned, the asset allocation is probably the most important thing. And when it comes to a multifamily office, constantly monitoring the asset allocation, taking advantage of, like, for example, right now when the market is falling, ensuring that, we're passing on this, advantage to the investors, by taking advantage of this drip and planning for their long-term growth is something that we get to do. So the day the markets fall down, we are extremely active, making sure that we are, all of our clients get to benefit from the fall in the markets. The other thing is also, I think, a few points which come to my mind, which I think we could quickly touch base on, is the cash flow planning for when we have multifamily offices, especially when the age profile of the client is different. When they're a little younger, their cash needs, it's more for a long-term wealth creation perspective, whereas if the corpus that is to be managed is for a senior person who's closer to retirement, then it's also about immediate cash. So then we have to start prioritizing allocation towards more fixed income opportunities, because they will start requiring income, in a shorter period of time. And the other thing is the difference between like how Mr. Manoj had also mentioned, single family offices are slightly more expensive, whereas multifamily offices gives you little unbiased advice, because we're not a bank, we don't have any pressure to sell any products as such, there's no targets as such. So there's access to unbiased advice, and at the same time at a fraction of the cost. Like, you don't have to be an extremely large corpus to establish your own single family office. And it's also unbiased because single family office is still, established under the group companies. Like, you're still an employee. So it has to be, it's like it's under the management of the family whose trust whose fund that you're managing. Whereas the multifamily office is an independent entity. So we don't have any reason to, hold back on advice. If someone has, they want to put in money in a very risky investment, we can just tell them that this doesn't align with our investment philosophy, doesn't seem to be good for you as well. So multifamily offices have that certain advantage. And now that, there's an increasing number of HNIs being created, a lot of wealth is being created, and there is a need for multifamily offices, and also a need for succession planning, as we see that the 40 to 50 age group is already started. They've got the wealth, and they also need to start planning for both retirement and succession, and that need is there. And instead of going to lawyers directly, they like to have their investments itself made in a manner where succession is a lot more smoother, versus just going to a lawyer and have their succession just written down on a piece of paper. They like to have their investments sort of made in different buckets, so that the transfer is a lot easier. So these are just some of the points that quickly came to my mind, which I thought I'll, of course, happy to answer some questions and also listen more to Mr. Raman and Himanshu on these.
Thank you so much, Karthika, for sharing your views. And just a build up on that. So as a family office, obviously there are many other things that family office also do, right? It could be philanthropy, taxation, succession planning, etc. So as a multi-family office, how do you, for your clients, how much time goes into the investment planning side of things and other side of things, for example, philanthropy, taxation, succession, and how do you, take care of all that aspect? I think we have talked a lot about investment strategies and how the investments are being planned, but on the other side of it, what additional services do you provide to family offices? If you can share some light on that?
So by traditional services, you mean like succession planning, or do you mean by?
Yeah, correct. Succession planning, taxation, हो गया, सब कुछ ही देखना पड़ता है ना family के लिए. And how do you manage all of that? Apart from investment, what else additional services that you provide to those families?
The others, of course, include taxation planning, and now a new space that has sort of started coming into picture is people have started exploring migration through investments. That's another we've not yet done, but then like through golden visas, and so especially even families with businesses, even we are trying to learn more of that space, because we see that this might come up, in the next 10, 15 years. So people who have businesses in India, they want to take advantage of, the visa opportunities and sort of have a structure set up in another country by way of investment, so that when the time comes, they have the option of either continuing that, because it's easy for people who don't have a business to just migrate. They just have to make an investment, get a golden visa, and move. But if you have a business, it'll take a little bit more of time to plan those things. We haven't yet started doing that, but this is a space that we explore. We're sort of researching, because we see that need might come, because you can't wait till the point where the government imposes some sort of taxation which is detrimental to your business or something like that. So a lot of families have started thinking ahead, or for example, if the next generation is not interested to continue with the business, or they want to move to another country, but there is a big legacy business to be taken forward, they start thinking ahead and sort of establishing a foreign branch or something like that, so that this is also sort of within the scope of family offices, which a lot of families are doing. A lot of legal firms are also advising on to set up these structures. A lot of banks are also working in this space. So this kind of structuring, all these kind of things happen on a need basis, and of course some of these are also made for tax advantages as well. So so this kind of planning works on a client-to-client basis, depending on the need. So when there is a need, that's when we work on these things. Otherwise, it is mostly on the traditional investment side of things. Because succession planning, taxation planning, as and when the need comes, that's when these conversations happen. But that said, our clients are always in touch with us. So many times they suddenly have a thought that, oh, they have to change their allocation between their children and things like that. So these conversations, we're always accessible to our clients, and then on a need basis, we work on these things.
Amazing, amazing. Thank you so much, Kartika, for sharing that. And just curiously, because we obviously have Raman, who has managed a single family office, and you manage a multi-family office. So how does a day in life differ for you both? As in, Raman, what was the day in life for you when you were managing a single family office? And Kartika, how is it for you when you were managing a multi-family office?
Sorry, I couldn't hear you. Could you just repeat that for me once?
Am I audible now?
Yes.
Kartika? So I was just asking you and Raman, because he has managed a single family office and you are managing a multi-family office. So how is it the day in life for you differ
Okay.
for both of you? Yeah. Maybe you can go ahead, Kartika, first.
All right. So a day in our life, I mean, I'm assuming it's probably most probably the same, because it's not like on a day-to-day basis we actively. I think I attended another webinar a couple of months ago where there are people from international single-family offices, multi-family offices, and when somebody was asked, what's the secret to like managing your corpus, your wealth, and he said a lot of times it involves just doing nothing. So you just have to stay calm and just get through. So a good part of that is actually that. So yes, of course we start our day by looking at the markets. That's the first thing we do. And like I said, when the markets crash, we do have to take advantage of it, and we move from liquid funds to making allocations depending on the client, so on. And that is how the first half of the day goes. And depending on the market situation, that continues till the afternoon. Apart from that, we also regularly have some things to evaluate, be it pre-IPO or bonds or something. So those that evaluation, allocation paperwork, and that activity goes during the day. And another good chunk of it goes both in interacting with clients, sort of responding to their queries, and evaluate. I would say the time is sort of split between evaluating, scouting for new opportunities, and executing them. So of course it's divided between the team, but this is broadly how our time. Yeah.
Okay. Thank you so much, Kartika. And Raman, how was it for you?
Very similar thoughts. Actually wanted to just say boring, but the days where at the family office, things don't happen on a daily basis, right? If you're moving things and if you're just trying to be busy, then you'll make mistakes. Once the deployment is done, I practically used to tell people that family office ka role khatam ho jata hai. Matlab the CIO's role is now then just chatting with people, meeting new people, understanding what's happening in the market once the deployment is done. Obviously, if new money comes in, you'll deploy that again and again, and all of that, right? So for a period when the money comes in or money is there or you're churning, it's exciting. My family office had a very boring mandate also. So 60% of our money was debt, 40% was equity and other things, right? So very boring mandate. I actually said that I met more people while I was at that family office than any time else. I used to reply back to everyone on LinkedIn. I used to do con calls and meet people very often, more so than I used to like doing it. But on the sell side, it's different. The days are packed because you're analyzing 10 different clients, 10 different portfolios. So obviously everybody has their own. Somebody just will call you up one day and say that मेरे को कल 10 crore निकाल के दे दो, मेरे को चाहिए. So things are very dynamic on the sell side. Buy side, things are pretty boring. Maybe that's why I moved out of the buy side, went back to the sell side. Maybe one reason was that. But all jokes apart, like Kartika said that you don't have to move things. Zabardasti kuch nahi karna hota, right? You have to just investing the way and stick to the process. Most of the investments are long term in nature, or so you believe. So whether the market's going up or down, it doesn't matter, right? So no action. वो fidelity का study है ना. Only two people make money in equity markets: one who buy and forget, and the other who buy and die. Right? So family offices have to be like that. Either buy and forget, or somebody dies, right? So it has to be very simple. It has to be very non my founder used to tell me that कि यार तू एक काम करना 20-50 करोड़ रख ले, वो ट्रेडिंग रीडिंग कर ले, उससे थोड़ा पैसा बन जाएगा एक्स्ट्रा. So I used to tell him कि मेरे को अपनी रात की नींद हराम नहीं करनी है. Right? It was very simple. कि मैं उसके लिए ट्रेडिंग करूंगा. My job is to, and Himanshu will agree to this. Our job is to make money. So if we make money, there's no incentive or there's nothing extra that we get out of it. If we lose the money, then we are gone, man. So इसलिए don't do beyond what the IPS tells you. Very simple.
Amazing point of view, I think. But yeah, trading, I think we have been discussing, methodologies for a while now. And Himanshu, I remember our conversation when we were in Mumbai. You were talking about the stock selection process, and it was pretty much a bit differentiated. So if you can shed some light on that.
So first of all, very well said, Raman sir. It is absolutely like that when you are working with family offices. Selection methodology for each class is different. Let me just give you some highlight on stocks and then mutual funds. So for stock, there are 4 things which we as a team look at it. First is fundamentals. So when we are saying we are into business of buying, so what we need to understand first, the business. So the fundamentals plays wide. But here, there are so many things which we need to see, shenanigans and all those factors as well. That's why to understand the business is a pivot role. Second, we call that fundamental analysis. After that, we have to do technical analysis on that particular business, that at what time we have to buy, right? Third, the fundamental technical valuation. So what is valuation? We always used to say, when you are getting 100 rupee note at a rate of 20 rupee or 25 rupees, that is called valuation comfort. Because market is always predict 4 ahead. So you need to see the best value of that particular business. Right now, if you will look at into the market, the stocks or the business are available at a very good valuation or mouth-watering valuation, but still, is this the right time to buy? For that, we have to see another thing that is called trigger. First is fundamental, then technical, then valuation, then trigger. Trigger is what? That we are just connecting the dot. For example, as one of our panelists said, that consumption, about the consumptional sectors and all. So if you can see from last 2 years, what is happening, a major takeover is happening to in healthcare side. So what is happening? Majorly family offices are investing into 2 type of business. Major of the portion who are very aggressive or goal oriented. Earlier, what was the methodology? They were into the wealth preservation. Now they turn around to the growth oriented funds. Earlier, family offices were thinking like that, we have to just procure our wealth, we have to be slow and steady growth. Now the methodology or the psyche has totally changed. Now they are saying we have to participate in Indian growth, we have to participate in that. That's why if you can see alternate investments assets, they are taking up new high, whether that is AIF, venture capitalist, hedge funds, PE funds, they are taking markets. And look at the listed companies, a lot of SME sector and listed companies which we have seen on the market. So fundamental, technical, value, trigger, these are the 4 factors which we see on each and every business while taking any bet. Now talk about the allocation, because to understand the business, it's not a big deal. How much you are putting into that particular business, it's a big deal. Allocation. So for allocation, there are mathematical construction models. Along with that, there is one primary phase which we used to say, we always used to take 2% of our equity portfolio. So our portfolio is divided into 4 parts. We keep 30% in equity, 20% in debt, 20% in real estate, 20% in fixed income. This is how the majorly family offices portfolio look like. Out of the 30, 50% are into now the startup AI funds. Earlier, it was not like that. But now this take is the new era. So this is the selection methodology of stock. Now talk about the mutual funds. So it's like finding out a good, the mutual fund methodology is divided into 2 parts. 50% weight we are giving to historical data, and 50% weight we are giving to futuristic data. But futuristic big data cannot be sure or say that this is 100% right. But through stats, we can say we are relying in between on the basis of some points. So for example, we have to see the rolling returns of the funds. We have to see the standard deviation, alpha on the standard deviation, stray ratio. What is stray ratio? Most of the people don't know about that. Stray ratio is stray from the benchmark or stray from your peer group. So for example, and another one is right to wrong ratio. So while analyzing any fund manager, because there are more than 300 open-ended schemes, how you will get to know which fund manager is doing quite well and how many stock bet they took into their portfolio and they did very well. So there is a method called right to wrong ratio. What is right to wrong ratio? Out of their 10 bets or 20 bets, how many bets went towards the right side and how many bets went to the wrong side? So we do all these analysis and got to know about that what are those mutual funds which is aligning the promoter's strategy or the objectives. So we keep all those funds shortlisted fund into the strategy, and then we give weight on the basis of Markovitch theory or the mathematical model. So this is how we select mutual fund and stocks into the portfolio.
Oh, that was pretty much very technical. But yeah, Kartika, you were asking something.
No, actually, there was a question for me which popped up and it went away, but I'll by Jitendra Jain. I'll just quickly answer that. He was asking, how do we select to onboard a new client at a multifamily office, and what is the process? So just to quickly touch base on that, and of course, everyone else can also add in their process. Our process is obviously an initial discussion to understand their goals, what is the size of corpus that they want us to manage, and what they are. The main thing that we look at is how they're already doing it, and if it is really required for us to help them, and where exactly we can add value. And that is primarily what we do. And it also, if they're already it is partially well managed, then it involves interaction with their other other professionals that they're dealing with, and we work with them. And in many cases, it is usually when they just want us to manage entirely and they leave it up to us. There are also cases where it's already pretty well managed, and in which case we decide how we are going to add value. This is primarily it. There is no limit or any minimum size. It's more of a need basis. Obviously, we see whether it's actually going to add value to them, because there is no point of us just onboarding clients and just when there is already a very well managed portfolio. So it depends on the need. Some of them also have these additional needs. For example, they want to make specialized investments in certain areas where even though they are actively investing through other professionals, we have access to certain investments that they don't have access to. For example, be it in the unlisted space or in the credit space. So they work with us only on a limited basis for just those. And or if they want to make some impact investments, Jane investments or something like that. So specialized needs. So some of them work with us on that basis. Some of them, they just want the general wealth management, succession planning, the overall. So we don't have any limit per se. It's on a need basis. The process starts with just a general review of their portfolio and their long-term goals and what is expected out of us. And then, we start by making the initial set of investments, the asset allocation plan. We tell them what we're going to do, and then we go after onboarding. We review with them on a periodic basis. That's pretty much how it works.
Thank you, Kartika. We have certain other questions also, so I'll just read the questions for all of you, and anyone can jump in and give answers to it. So we have received a question: what is the best structure of a family office? Please advise. Raman, like to try? Yes.
For family offices, totally depend upon client need. No, there is no I can say predominated method that this is the structure, this is the way you should do it. For the compliance and all those part, there is a way, but for the strategical side, it's totally depend upon the client's objective. On the basis of client objective, strategy needs to be built. This is what my understanding is.
Okay. Anyone else want to add on to it?
No, same thought. No one size fits all strategy. It's all customized. as you become richer, everything that you buy or sell or do anything, it becomes customized for you. So the rich people like doing customized things, and we as advisors only provide them services like that. So very different. Some people have families in India, some people have families abroad, some people have 2 kids, some people have 10 kids. Depends on some people have brothers and 5 brothers running the show. So everyone's very different from each other.
I think the question is relating to the structure of the entity which is managing the fund. Because it is unregulated entity, even if it is a multi-family office, it is not regulated by any regulator. So you can do individually also. If you are, let's say, capable person like Himanshu or Raman, they can manage the fund of 2-3 people easily. So there is no need for having any structure. Otherwise, you can have a LLP or private limited company, as the case may be, as per your wish.
Manoj, the need for structure will only come in if you want to be tax efficient, right?
Right.
People typically either form a LLP or a trust, or let's say a private limited, primarily just to be at the lower end of the tax bracket and put some expenses there, etc.
Right.
If you're doing on individual name, most of these guys will attract a 40% or approximately a 40% tax, right? So primarily structures will come in from the tax requirement rather than anything else.
Right. Tax is the biggest factor. If we are talking about the individual family office, it totally depends upon their tax implication and how to mitigate that. So that structure can be advised.
So the same participant has asked an additional question, which is, are there any regulatory framework like SEBI, etc., regulating the family offices as yet or expected soon? So
if you're 500 crores and above investing through companies, you will fall into the NBFC criteria. So maybe you'll have to take an NBFC license eventually, except all of that. If you're lesser than that, or you can spread out investments, you will still be able to do 100 crores of 5 entities, and then you can manage it being under the radar. As the family offices become bigger and bigger, they create these holding company NBFC structures within themselves. So if something like that comes across, but it's their own money, their own company, they don't want to be governed by RBI, SEBI, etc.
So are there any similar sort of restrictions country to country, like beyond India, if there are some sort of restrictions of maybe from any regulator?
So
Ruchika,
if you're directly trading in stocks and the entities, and you take a QIB license in India, then obviously you'll come under the SEBI purview. Same way in the US, as family offices are much larger there, SEC keeps a close eye on them. So there are, if you're doing crypto in India, then obviously there will be certain notices that will be sent to you. All of that will happen, but typically I don't. Most of these family wealth would want to be away from the purview of RBI and SEBI.
Right.
Yes, sir. You were
NBFC. Yes, it is only about the NBFC. If the investment happens through an entity company, and then obviously, as the criteria is having more than 50% investment and income from investment in the capital market or any security or financial assets, then it becomes a deemed NBFC, and registration as NBFC is required. Otherwise, it is not. And portfolio management, personal portfolio wealth management, or is not required to be registered as a broker or any other entity. So, but yes, the persons who are managing like multi-family offices, they are not. They are just advisors, so they are not regulated by any entity.
No, they have to be registered as well. They have to get an RAA license. They have to get a PMI. Yeah, so they have to be registered. So they are primarily an advisor. So for advisors, you have to get your own license.
Yes. If they are doing majorly in the listed company and capital market,
even
yes.
individuals, if as an individual I'm advising a family, etc., I have to be licensed. I have to be NISM certified. All of that, I have to do all of that as well.
okay.
Even nowadays, if you want to sell PMS also, you have to take NISM certificate.
Right.
But now it is mandatory.
Another question is, who can set up a multi-family office? What are the key requirements? Kartika, if you are here, you can answer to this question.
I think number one would be money, and rest Kartika can answer.
So anyone can pitch in.
Okay.
So sorry, Himanshu, you want to go?
Yes, you can answer.
नहीं बोल दे यार, देखो पता.
I would love to hear from you.
Okay. पहले आप कर रहे हैं हम लोग. हाँ. Yeah, multi-family offices are generally set up by people who have been part of wealth management, etc., for a while now. So they have ready set of clients who they can move from, let's say, a Kotak, IFL, all of these guys. So a lot of multi-family offices are guys who have been in the industry for 15, 20, 30 years, and they have certain amount of people, investors, who were willing to move with them. The most important factor is, asset under management. All the licensing, etc., are very, very simple. You don't require too much money for it. You need to incorporate a company. Licenses are, let's say, on top, office सब कुछ मिला के 2-3 करोड़ रुपए लगते हैं, सब कुछ हो जाता है. The only important thing is that, do you have steady clients with you? So if you can't start, or if you don't have clients who can put on day 1,000 to 1,500 crores, eventually you will not be successful in this, in a multi-family office endeavor. So the recent ones that have, or you create a moat around a different type of product. So for example, if you know of this company called Deserve in Bombay, Deserve started as a wealth management platform. Now they've become into a multi-family office as well. And same way with Centricity, started as a multi-family advisory platform. Today realized that advisory has no money, so started selling products. So eventually, everybody comes into the wealth management foray only, and you become a similar product centric or advice centric play in the country. Either when Kotak started back, there was nothing called multi-family office or family offices. When today, let's say a Deserve is starting, they already had a pool of 1,000-1,500 crores coming in from their existing investors.
Okay.
Just to quickly add to Raman sir's points. Sorry, my audio was not working. I was not able to answer it earlier. There are some multi-family offices which are actually just an extension of one single family office. They're primarily established by one large single family office, and then there's just another format of multi-family offices where they extend, and because they have in their social circles and professional circles and other HNIs who would like to be a part of it, so they expand and become multi-family offices. That's just another way in which multi-family offices are created.
Manshu, you would like to add something?
No, I think Raman sir and Kartika already answered in the right manner. I would also answer in the same way. So it's perfectly answered.
One question.
Can I ask one question here?
Yes, please.
Yeah, am I looking very old on this thing? Why are you guys calling me sir? Yeah, मैं आपकी उम्र का ही हूँ यार.
More wiser.
No. Seriously, I'm thinking if I'm looking older in this conversation or something like that. No, please. Sorry,
No,
just to digress.
Not at all. No, I'll not say. I'll say Raman.
Thank you, please.
Okay, so we received certain questions prior to webinar also, in which one is, I think can be put right now. How one should decide whether to go between, whether to decide between single family office or multi-family office. So anyone, like, you can say about it.
So first you need to understand the difference between single family office and multi-family office.
Yes.
So as Manoj sir rightly said in the earlier conversation, single family office means when you want everything customized and in-house and you want to take all the cost on your head and everything. And multi-family offices, if you want to join another family and together you want to form something which can help you to benefit your cost and so many things. So multi-family offices like that, I think Kartika can answer this thing very well.
Yeah, I mean, on the same track only, Himanshu. So the choice between single family office and multi-family is a very personal thing. It's your personal wealth. So it's a very personal choice. People have different approaches to money. People have different, for example, there are some people who are very low profile, even though they'll be sitting on 1,000 crores. So they're very discreet and they don't like other people knowing it. It makes sense for them to have a very close knit of people managing their wealth, and it'll be under their single family office. Some people are a little bit more open. They don't want to take the headache of, because when you set up a single family office, it's not just the cost, and it's also the management of the single family office, where you have to hire the right people and then you'll have to retain the right people to manage it. So it's almost very similar to setting up another little mini company, to like financial services company, to manage your own wealth. So that management also falls into the family's head. So whereas a multi-family office is an independent, established structure which will run whether or not your family's wealth is in it. So in that case, you can, that is another choice. If you don't want to take up that responsibility of setting up a single family office. You can go to a multi-family office. So it's a very personal choice. There's no fixed answer per se. There is no such thing that you should be of a certain size to be a single family office. I mean, it just makes more sense when it is of a certain size. But at the end of the day, it's a personal choice, and convenience depends on the family's needs and preferences.
So adding to what you have said, we received a question: how much wealth should one have before starting a family office?
Yeah, I think I just answered that. There's no like fixed answer per se. If you think that I have money that I can't manage, which has to be managed by someone, I can go to a bank wealth manager, but I want it managed by a family office. It really depends. It's a very personal choice. There's no fixed answer per se.
So, Kartika, what is the minimum amount that you are, maybe for a client you are managing?
Yeah, we get this question a lot, but unfortunately, there's no right answer. I think the way to decide, if I had to give a very practical answer to that, the way to decide is you need to compare it with the associated cost and see which makes sense. Does it make sense to go for a family office, or is it just better to my advisor and whatever options he's given, that's good enough for me? Depends on the own family's strength. Also, a lot of people with wealth already know how to manage wealth. So it really depends on their needs, what they're able to do on their own, and whether there is actually a value add versus the cost involved for going with the family. So that's pretty much like any other decision making.
I think someone from the participant has given us the questions in the line. So someone is asking, what are the key costs associated in setting up a family office? Like, as you mentioned, that the money you have to invest and the cost associated needs to be rationalized. So what do you think? Anyone can answer to this question?
So the most important cost is people cost, hiring a CIO team, etc. So typically, and when we were setting up family offices at Edelweiss, we used to tell a lot of our investors that if you don't have 500 crores, don't set up a single family office. Always go for multi-family office or advisors, etc. Work with wealth managers. Why we used to say that is that typically a good CIO will cost you anywhere between 1.5 crores. The team will cost you another 1 crore. So 2.5 crores is people cost. Then office space, their travel, their research, etc. would cost you. So typically you will spend on a yearly basis, you will spend 5 to 6 crores just for managing this family office business. Okay. So 500 crores, assuming you will make 10% post tax, etc. 50 crore बना रहे हो, 5 crore रुपए आप उनको दे. Simple math. Yeah. And so then it makes sense. Otherwise, what you can do is that take that let's say 499 crores, hire 2-3 different advisors, spread the money between them, let them compete with each other, and eventually, in 3 years later, see which ones perform the best, where you have the least hassle of operations, and then obviously pass that money on to that one person. So typically that's how we used to do it. There the typical cost lands at anywhere between, again, 0.5 to 1.5%, depending on where you are at. So on, let's say 500 crores, it will again be the same, right? So depending on that, घूम फिर के वो amount same बनता है, but having said that, you get some amount of flexibility when you're smaller. Once you're bigger, everybody wants to control everything in-house, because it's not only just the investment part, it's also a lot of deep dark secrets of the family. The brothers are not getting along, the wife is not getting along, all of that also comes in. So you need somebody trusted to talk about all of these things as well. So over a period of time, either the wealth advisor becomes close enough to the people, to the family, or they hire somebody who they trust into the fore. So it's more about trust rather than just the amount, like Kartika mentioned, that it's not the amount, it's just that that today I only have 200 crores of liquid assets, but in the next 5 years this will be 2000 crores, right? So you can start building your team today onwards, and over a period, and you also have a vision for yourself.
Understood.
Treat it as any other business that you
I think one of the best answers to understand the nitty-gritty is actually involved in single family offices.
Right. So I think there's just one last question. How can a company secretary in practice contribute to the family office? Also, would you like to add something?
I don't think it's anything about company secretary, or it is about your skill of managing fund. If you have, obviously your role is there. So any professional can have this kind of.
I think Raman ji said very well
Yes.
I did not say sir now. So
Raman
जी
ji.
भी बोल दिया यार तूने तो
he said,
Yes, the answer is very good.
if you are very close to the family and the family is having trust on you and you are having those skills, then whether you are CS or CA or MBA, it doesn't matter. You just need a skill set and a trust. That plays vital role. I think this is what I can say in that.
Yeah, that's great.
Okay, so this comes to an end to our webinar. And as a part of our ritual, I would ask every one of you to conclude it in 30 seconds. And just to, I'll start with Kartika. Otherwise, Raman would say that I'm treating him as the most senior person on board. So, Kartika, from you, then Raman, then Himanshu, and then our panelist on board. Just 30 seconds.
Sure. Thank you, Ruchika. I mean, just very thank you for having us, for having Conscience participate in your webinar. We read at the firm, we read Shivanshu's writing almost every day. We also discuss it, like, oh, Shivanshu's written this. So we're very happy to be a part of some of your webinars. We've also attended Shivanshu's other pre-IPO SME pre-IPO and pre-IPO webinars as well. Thank you so much for having us. I think this was a very essential one. There's a lot of family offices is actively booming, and I'm sure this will help everyone gain a very short introduction or understanding into the space. And feel free to reach out to us if we can. Happy to have an informal chat to explore how we can add value to each other and share opportunities with each other. Thank you very much.
Thank you, Kartika. Yes, Mr. Raman.
Zuri, no, thank you so much for having me here. And Shivanshu was never a colleague to me. From day one, when we started working together, he's always been a friend. He's always someone that I've always relied on. So if ever I make a family office, Shivanshu will be the first one because I trust him so much. First one that I'll reach out to. But overall, like Kartika said, this space is booming. We also have to recognize that we've been in a bull market for the last 4 years. So bull market brings in a lot of complacencies as well in the system, which is what we are seeing currently. Maybe in the next 6 months, the topic might be different. How should family offices navigate this bear market? But today, as on today, a lot of excesses have been built up on all ends of the spectrum. So today we need to be just conscious about the fact that we don't really go overboard. Family offices should not be. These are decisions that are for the lifetime. A lot of people in the past just being scared that there could be inheritance tax. एक बार अरुण जेटली ने बोल दिया that India had an inheritance tax, started making trusts and everything, and now they are stuck. So things that people need to do today is the fact that just be in the moment, just think about how they are building it, not to be worried about single family or a multi-family. Keep the flexibility intact, right? You don't know what your plan today are, and maybe the plans might change in 2 years' time, or maybe Nirmala Sitharaman will come and put tax on everything that you do, right? So we don't know. But having said that, it's a great space to be in if you're either working with them, looking to form, or just right now just starting your investment journey. Eventually aim has to be that one needs to be sensible enough to become a family office eventually.
Thank you, Raman. Yes, Himanshu.
So first of all, thank you so much for having me over here. And I think most of the points are already covered by Kartika and Raman. So the one thing which I will say, currently India is having 166 billionaire, and we are expecting this number will grow at a substantial rate. So the family office business will also grow at a much higher space. And to see the avenues and things, or where whomsoever is worried about seeing market and all, I would say only one thing: just read Greater Fool Theory. Then you will understand why market fall, what will happen. It's all about psyche. So just read Greater Fool Theory. You will understand how these things turn around, what will happen, that as Raman said, that after 6 months we will be speaking about this is the point where we should enter and all those points. So just read that. This is the intake, and I learned so many things from the panelist and corporate professional team. And again, thank you so much for organizing such a wonderful session. Thank you.
Thank you, Himanshu. Manoj sir.
Yeah, I think everyone has said very well. Raman has clearly said that the market is booming, so the investment opportunities would be there. Yes, there will be market turns when if it goes up, it will also come down. And obviously, even after such a market fall, still many companies are very high valued. So it is not only about the listed companies, shares, or capital market investment. It is the entrepreneurship which will develop if the investment of the family wealth goes into the business. So this cycle should continue as the HNIs and ultra HNIs are getting created. They should continuously invest in entrepreneurship, and that could happen formally and in a structured manner through family offices or multi-family offices. So I think this journey will continue. It is still evolving, and only 10 years has happened, and the cycle is just started. So it will continue. I think we should be participating in this journey. Thank you. I think.
Thank you, sir. Now our founders of Makia Capital, Sanchit.
So I think it was a very pleasure having all the panelists, Raman, Kartika, Himanshu, hearing their nitty-gritties in their management styles, the family offices landscape, and with the family offices playing a very increasingly influential role in today's India's wealth management, their impact is only set to grow in the coming years. And I think it's a very interesting space to be in, and we're really looking forward. And yeah.
Thank you,
Thank
sir.
you.
Last but not the least, Shivanshu.
So I won't bore you with all the gyan on family offices. I think we have been discussing it for past 2 hours. But really thankful for Raman, Kartika, and Himanshu to join in. Unfiltered advice, unfiltered experience they have told us, and even Raven for that matter. He left in between, but I think this has been really helpful. Even I think this has been a huge learning experience for us as well, and very even for the attendees. I think really excellent questions. So that's what I think we are trying to bring on the table, and how we are just focused on providing that free education for all, in a way. And thank you again, Raman, for the kind words, and Kartika for joining in and chiming in with your experience, and Himanshu as well. So it was pleasure hosting, and up to you, Ruchika. So now your last words.
Thank you, Shivanshu. Thank you.
And
everyone.
sorry. And one more thing. So we just to reiterate, we decided on this topic on Tuesday, I guess, and I think it was a very quick turnaround for our team, even with one holiday, to prepare all of this in sending invites. So kudos to Anushka, Tanmay, and Murtuza for that matter, which is Market Capital team, and even corporate professions team, Shivam, and everyone else to put this in no time. So again, I think one of the most interesting webinars I've been a part of.
Absolutely. Thank you, Shivanshu. Thank you, all the guest speakers and all the participants who have taken time out to join us in this journey. Our webinar journey will continue. And as I mentioned, we'll have our next webinar on 7th of March on Q&A on industry standard and minimum information to be provided for related party transactions. So thank you, everyone. Let's meet next Friday, 4 p.m.